Hey guys, and welcome to Money Talks News You Can Use. This is our new short-form podcast. We're going to try to answer some questions and deal with daily stuff. I'm Stacey Johnson, your host, and with us we also have Kim Wynn, our social media director. Hey, Kim.
Hey, how's everybody doing?
I'm doing flawlessly. And how about you, Aaron, our producer and my good friend of many years? How are you doing?
I'm doing great, except I had to clean this whole mess up just so we can do this video podcast.
You know, it's funny. I did that too, because usually our podcast, for those of you listening and not watching, we usually just do audio, but now we're doing video, so we had to clean up our backgrounds today.
Yeah, and Kim's background is awesome. Look at that. We got Darth Vader.
His is good.
Yeah.
Stormtroopers.
Yeah. I am a bona fide nerd. I haven't been on a podcast, so I didn't have to worry about my background. I finally get to use it, so I'm very excited.
Finally. Well, usually, just to let you know, I usually put Emmys behind me because I won a couple of Emmys many years ago. And I always get teased when I'm on a podcast. Like, oh, Stacey, couldn't help but see you had Emmys, because I always put them wherever I am. I put them right behind me. But I didn't do that today, so I'm just telling you guys I had to.
Oh, you're humble today. Okay. You're humble. Okay.
Yeah, that's right. Except for
very humble.
Kind of blew that. So, Kim, we want to say hello to some of our new members of our retirement group today.
Yes. Obviously, Stacey mentioned I handle social media for Money Talks News, and we have a Money Talks News retirement group on Facebook, and we are getting a lot of great members there. I just want to shout a few. We have File, Archie, Marie Lewis, Arlene Leclerc, Peggy Burns, and Carol Tissue. Hi, guys. Thank you so much for joining the group. And if you want to join a group, find us on Facebook. Type in the search bar, Money Talks News Retirement Group, and you will find us there.
And it's not just for people who are old like me. It's also for people who are young like you. Right, Kim?
Yes. Somebody thought I was very, very young. Thank you, Stacey, for that earlier compliment. I'm in my late 30s, but honestly, I'm starting to think about retirement now. On it, if I can, I would like to retire early. So
it just occurs to me, you guys, we have almost every generation here. I'm 69, Kim's 37, and Aaron is 50. Aaron, is that what you are?
Yeah, 50.5.
Right, we got our bases covered here. So what are we going to talk about today, Kim? We don't have a lot of time. We're going to try to keep these short and sweet. What are we going to talk about?
Well, today we're talking about the Federal Reserve and the cuts for interest. So there's a lot going on over there. You know, and what does that mean for your portfolio and retirement plans? And I'm going to pass this on to you, Stacey, because I thought it was as simple as just, investing in my Roth IRA and saving money. What does this have to do for me?
And it is, really. First of all, let's back up a step. The Federal Reserve is meeting on September 18th. They meet pretty much every month. They skip a few months out of the year. So they're meeting on 17th is when they're meeting, and the 18th is when they pronounce what they're going to do. And widely expected for them to cut interest rates by a quarter point. I would say the odds are 95%. I mean, as certain as things ever get in the economy, it's pretty sure they're going to be cutting rates. So the question is, what do we do? I don't like to use the word portfolio because that sounds kind of stuffy, but how's it going to affect your savings? So let me ask you guys something. You know that you read a lot. I mean, obviously you work for Money Talks News, so you know that this is happening. Yep. What are you doing? What are you doing, Aaron?
I got to tell you, since we've been doing the whole stock market thing back in the past with the podcast, I invested in a bunch of stuff, and some of the stuff didn't do very well. So I'm like a lot of people. I parked a lot of it over in savings accounts, high yield savings accounts, and I think I'm in that same group of other people going, okay, if this is starting to happen, do I start moving it back into my brokerage accounts to start investing? Because I played it safe for a while.
Yeah, me too. I've got a lot of money in the stock market, but I also have a lot of money in savings. And boy, has it rocked having 5% interest rate with no risk. Yeah. I mean, that used to be the deal. You guys don't remember, but because you weren't born yet, your parents hadn't met. Your parents hadn't been born yet, probably. But anyway, in the early 1980s, when I became a stockbroker, interest rates were literally 20%. On money market funds.
That's crazy.
Wow.
Yeah, but unfortunately, mortgage rates are also 13 and 14%. but imagine, I'm cold calling people saying, "Come on, you should buy stocks." I mean, this is what I was doing when I started off as a stockbroker, and interest rates were 20% on savings accounts.
Yeah. People were like, "Are you crazy?"
Imagine how hard I had to try to sell to get new accounts. Anyway, that's neither here nor there. Interest rates are probably going to drop a quarter point in the middle of September. And then they're probably going to drop a quarter point more almost every month. I would say within the next year, interest rates going to be lower by 1%.
Really? You think every month? Because I've read speculation that he's probably going to do this and then just hold to see what happens.
Well, it could be. I mean, if you ever listen to the federal chairman, the chairman of the Federal Reserve, rather, Jerome Powell. Yeah, he'll first of all, he'll put you to sleep. But if you are listening to him, he'll say, this is all data dependent. We're going to lower interest rates by a quarter of a point, and then we're going to see what happens.
Right.
So yes, that could be true, but they could continue to lower them. And you know what's interesting too about interest rates? Do you think it's good for the stock market or bad for the stock market when interest rates go down?
I've always read that when they do this, not always, but it seems like a recession follows. So I don't know whether it's good or bad. I mean,
that's kind of what I've read as well. I do agree with that. Or at least that's what I've read.
It seems to be because they're always behind the eight ball, and the economy's finally caught up. The data's finally caught up, and they're like, "Oops, we started too late." And that's why there's also articles out there saying there's two different economies going on right now. One's already in a recession, and one's doing well. Yeah,
and this is true, but there are two schools of thought here. One is if interest rates are falling, well, that's good. Because consumers now were able to buy cars that they couldn't afford before, or houses, and all doing all kinds of consuming things, and businesses aren't paying as much interest either, so they're more profitable. Right. So it could be that makes it sound like it'd be good for the stock market, doesn't it?
Well,
on the other hand, though, the reason they're lowering rates is because the economy's slowing down. That's bad for the stock market.
Right.
So both things can be true. It just kind of depends on the attitude people have at that time. And so whether this is good or bad, I don't know the answer. But
so why is the play, like everybody's saying, like they're pulling out of stocks and all these other things that are technically, the PE ratios are crazy overbought, and they're now moving it all into like what they call defensive stocks and stuff like that, and gold. Why are they all saying to do that?
Well, first of all, I don't think they're all saying anything, but you're right though, Aaron. I do see this a lot. It's hard for me not to look at you guys on my screen instead of looking at the camera. I'm trying to focus on looking at the camera. And anyway, I think that the stock market is way overvalued. First of all, historically, by almost any measure, the stock market is overvalued, and the economy is slowing down by almost any measure too. Now, maybe it doesn't get slow down enough to go into recession, but it's slowing down. I mean, the unemployment rate is going up. There's any number of measures.
Well, nobody's buying cars anymore. I actually just saw a commercial on the TV the other day where a car dealer was offering 0% financing. I mean, that wasn't happening. It's because nobody's buying anything.
Yep. So the economy's slowing down, so people get defensive, right?
Yeah.
Because the stocks that are most overvalued, like technology, I know that both Kim and I own NVIDIA as an example.
Yeah.
I'm really happy about that. By the way, thank you, Stacy, for having that conversation with me.
Yeah, well, actually, though, you're about even on it when you bought it just after the split.
Yeah,
right?
Exactly. It's kind of that dip we saw earlier in August was like a little worrisome, but then it's kind of correct.
And I thought yesterday it was going to go. We went down to like 115 yesterday. Anyway.
Yeah.
We're not supposed to be talking about that.
Yeah.
But anyway, so as stocks get more overvalued and the economy begins to slow, people are obviously going to go into things that might not get hurt as much. Utility stocks would be a perfect example of that. So there are some things that people have to buy no matter what. And power is certainly one of them. So that's what Aaron means when he says defensive stuff. I personally am not doing a lot of that. I still have a lot of my money in technology. I also have a lot of money in oil stocks, which also wouldn't do as well in a recession. So I'm kind of still invested.
I was going to question you on that.
Yeah.
So I read a paper the other day. This guy is saying that one of the things that could be bad for the economy is oil going up, and yet usually oil's now what, 70 something a barrel?
It's 75-ish.
75 a barrel. So you don't think that's going to go up?
Well, now oil, generally speaking, is going to reflect the economy. If the economy is booming, then obviously people are using more energy. What's happening with the oil market now is that China has slowed down a lot too. And so that's kind of keeping a lid on oil prices. But oil is really not where you want to be if the economy is slowing down in general.
Okay.
And nor is technology. But I'm in both of them. I'm just looking through the other side because once recessions don't last long. Even if there is a recession, certainly a slowdown. But even if there's a recession, not going to last forever. But let's get back to the topic at hand here. I'm trying to do a 10-minute podcast. And I'm just hopeless because I just talk. Anyway. what are you guys doing, or what do you think you should do when you know interest rates are going to start to come down? Let me ask, what are you specifically doing, Kim? What are you changing? Anything?
I mean, for honestly, right now, I'm holding fast. I'm still contributing to my high yield savings account. I'm at right now 5.5%. So like that's just easy for me to think about. And then I think we talked about this in the past. Is I am dabbling in more of the individual stocks and kind of looking at right now those defensive stocks to support and to kind of help bolster myself and cover my bases.
What about you, Aaron? Are you doing anything specific? If you believe, as I do, that interest rates are coming down, what are you doing about it?
Well, one, I haven't moved the money yet back over because my savings accounts are still doing well. But if I do, I actually don't know. I don't know what to get into because I believe technology is oversold. I think the AI has actually reached its plateau of usefulness, and I think it's going to have a little curve where it's going to go back down, where people are going to go, oh, okay, this is not doing anything, it's not moving anywhere, and then eventually it finds its usefulness and goes back up. That's a curve that happens all the time. So
basically, you're not doing anything either.
No, and I've been debating on do we do dividend stocks? I mean, everybody's saying
dividend stocks are a good idea when interest rates are falling.
Now, why is that?
Because that the rate that they pay, if they pay a high dividend, that becomes more valuable as interest rates fall, right?
Okay.
In other words, when you're earning 5% for doing nothing in a savings account, and then this dividend stock is paying 6%, and your interest rates start dropping in your savings account, you want that dividend stock, right? Pays you more income.
Right.
And so that makes the dividend stock more valuable.
Are companies more apt to raise their dividends during this time?
Companies raise their dividends when they become profitable. But I put this question up in the retirement group. What are you guys doing? Interest rates are falling. And basically they did the same. They said basically the same thing you guys said. Nothing. Now here's what I did do. I did move significant money from my regular savings account, my money market account, into an intermediate term bond fund. I did a municipal one because I'm in a high tax bracket, but I also did a couple of corporate ones too. So why am I doing that? Because bonds, I'm trying to lock in an interest rate.
Right.
I'm earning 5 in money market. I know that's going to go down. I mean, it's going to go down the day that they cut rates, the Fed cuts rates.
Right.
So I'm moving some of that into medium term, like 5 to 7 year maturity bonds. I did that through ETFs. I could have bought the actual bonds just like I buy individual stocks, but I did it in ETFs. I did that for 2 reasons. One, because it'll retain, because they pay more interest. And now I'm locking in that interest for 5 to 7 years, theoretically, in an ETF. And 2, bonds go up in value when interest rates go down. So if you bought $1 million worth of 5-year treasuries today and interest rates dropped to a point, you could make $100,000 easy in profit. So I'm doing that for 2 reasons: A, to retain some income, and B, to see maybe I can make some capital gain. And I bought the bond funds a couple of maybe 2 weeks ago, not long ago, and I'm up a little bit on them. A few $100, not a lot, because bonds don't move all that fast. But that's one thing you can do, and that's one thing I have done.
And if a recession hits, does that bond still hold true? Does it still work, or doesn't?
Well, yeah. As long, okay. Now I bought most of what I have is really high quality, but I do have some less than stellar quality bonds, and the reason why is because they pay more interest. But if there's a recession and it's severe, and these companies in my ETF go out of business, then obviously I take a huge hit. So, if you're buying high quality bonds, the odds of that happening are low. And if you're buying in an ETF where it's a diversified portfolio of bonds, they're even lower. So I took that chance. I still have a lot of money in money market, though.
Right.
But at least I did something to try to retain that high interest.
What about if you grab a 5% CD?
Yeah, that's a great idea. I mean, if you don't need the money and you can go out to 5 years and lock in that 5%, because, a couple of years from now, the top CD rate may be 3 or 4. So why not lock in 5 for 5 years, providing you obviously are not going to need the money for 5 years?
And there's a penalty, right? Or your money's just locked in.
No, you can get out of a CD, but there is a penalty. So, some don't even have penalties, but generally speaking, it's, I think, 6 months interest if memory serves.
Yeah, I think so.
I've never bought a CD, actually. I buy treasuries.
You were talking a little bit about kind of like diversify into different spaces, talking about bonds and CDs. I've heard a lot about gold, and honestly, I have no idea what it actually means to buy gold. Like,
or how.
I know more about crypto than I know about gold at this point.
I own some gold and I have forever. I mean, but it's
Yeah,
it's not 10% of my portfolio. It's less,
right.
But gold does tend to go up, and it has. Gold's hit new highs.
Yeah.
Recently, so gold does tend to go up as the dollar falls, and the dollar. I don't want to get too much in the weeds, but the dollar tends to fall when interest rates go down. So the gold's done very well, and probably will continue to do well. Still, no more than 10%, and probably less should you put into gold ever.
And how about this? I've heard things about investing in small cap ETFs. Is that a thing? Is that because the borrowing goes down and small companies, try to do things, or what's the deal with small cap?
Well done, Aaron. That is true. I do own some small caps in an ETF, and I suggest other people do that too. As interest rates fall, these are companies that borrow more, and they tend to do better as interest rates come down. Again, if the whole economy goes down, these stocks go with it. But this and small stocks, as represented by the Russell 2000, if you want to follow small stocks, they tend to outperform when the economy starts rebounding, and they have underperformed the S&P 500 for years now.
Yeah.
So that's probably not a bad bet.
Is there like a percentage split? Like you have X amount of money. Is there like a percentage split you would do between all of these, between stocks, bonds, ETFs?
Well, I was going to ask the same thing.
Yeah. What? Okay, let me ask you guys something. In your long-term savings, what percentage do you have in stocks versus interest-bearing stuff, like money markets or whatever?
Go for it, Kim.
Well, I mean, I really feel like I'm just starting out, honestly. But right now, with my current kind of, savings, I have a lot of it in retirement savings, just because that was kind of the golden rules. I thought I'm going to max out my Roth IRA. I'm going to max out 401k.
You mean in stocks, though?
Oh, yes.
Yeah.
So I'm investing in. Honestly, I've been keeping it pretty safe. I've been investing in index funds. Really safe stuff. Obviously a little more high risk because of just my age. On zero in bonds at this point.
Yeah.
But I have about, I would say, 10 to 15,000 in individual stocks.
Oh, that's cool.
The stock market. And that's just enough.
You should have
me.
most of your savings in stocks. Obviously, you're 37 years old.
Yeah. So it's been, and I've seen since the pandemic and now just a lot of shift. Good, bad, but net positive at this point. And on top of that, I'm trying to save to buy a house. So that's something that's an added complication for all of this. Do I stay where I'm at currently, or do I go invest in real estate?
Well, I'm sure you know this, Kim. You don't ever put money into the stock market that you're going to need within 5 years.
Yes, absolutely.
Yeah.
So that 10 is just there. But additionally, like I do want to own a home at some point. So
yeah, that's a good rule.
And speaking of which, Aaron, you probably have a lot of your net worth in real estate.
Yeah, so a lot of it's locked up in real estate, and then the rest of it, like I said, is in the savings accounts, high yield savings accounts. And I have, when we started this podcast, I started, doing a little portfolio thing, and that, the money's still sitting there, but the stocks that I bought in there, I basically tried to make them back up with other things. But I do have a little IRA that I started, and I stayed to code the investing code that you're supposed to, which is, the S&P 500, all the big name companies. I have Apple and Microsoft and all those guys.
Same.
And that's done well, but it's very small. It's a very small percentage in that IRA. Eventually,
the S&P 500 is a great place for people to be in stocks anyway. Yeah. I mean, I'm an individual stock guy. I have 35 different stocks. But I also have an S&P fund too. I think that having that is fine. We haven't brushed on, and we have to. I'm sorry, you guys. I just talk so much. We haven't talked about borrowers, because what's bad for savers is good for borrowers. Interest rates are coming down. So if I'm you, Aaron, and I'm a real estate investor, I'm probably not taking out a mortgage here. I mean, mortgage rates are about as low as they've been for a year and a half. They're probably going to get lower.
Yeah, they're probably going to get lower. I'm going to keep waiting until he keeps dropping those rates before I'm starting interested in real estate again. Yeah.
Yeah, and as the economy slows down, guess what else happens? Fewer people are buying houses, so the housing prices could also come down.
Yes.
So I'd be waiting here if I were a borrower, and I'd be
I like
trying to
to hear
lock
that.
in if I were a saver.
Yep.
Make sense?
We are still 8 million houses short, but they are building. But
True,
it doesn't mean the price of houses are going to go down, but at least the borrowing will go down, which could actually, cause housing prices to go back up. So who knows what's going to happen there?
Yeah. Okay, guys, it's been 20 minutes.
Yep. We need to wrap the show.
When we started this, just so you guys know who are watching or listening, I told these guys, L3, we're going to talk the exact same amount. Nope. Stacy runs his mouth, and I apologize. So next time I'll try to be a little quieter.
I am an eager listener, if anything. So,
well, cool. Okay, guys. Well, definitely check us out online. If you're interested in saving for retirement, go to Facebook. Just look up Money Talks Retirement. Also, we have a regular Facebook group. We're social media, man. Where else can you find us?
we are on everything, y'all. We are on Facebook at Money Talks News. You can just find us there and search there. We have Instagram at Money Talks News there. We have TikTok. We have, if you really, really want to get in the weeds, we have a LinkedIn if you want to check that out. And then we also have our YouTube channel, Money Talks News. You'll be seeing a lot of Stacy and probably a little bit more of us, right? Now that we're back on video. So
right.
We're really excited to have you.
Well, I'm going to start working less, so you guys can start working more. Okay, kids, you guys have a great rest of your day. And folks, please tune in, follow us, like us, recommend us to your friends. Do all the things that make me money, okay? Thanks, folks. We'll see you again next time.